UK unemployment fell more than economists forecast, to the lowest in almost 5 years. Yet still the Bank of England Monetary Policy Committee see no immediate need to raise rates. But what will the markets think of this? Joining me down the line to discuss is Jinny. Jinny, the minutes from the MPC meeting outlined members believe unemployment rate will fall to their threshold materially earlier than anticipated. A large percentage of analysts believe the Bank of England could lower that unemployment rate in line with the Fed to 6.5%. But just 6 months into the job, would that raise a question over credibility of the central bank?
Yes, maintaining credibility is indeed exactly the key factor here. Our view is that to change the threshold itself will equally raise questions over the Bank of England's credibility. So with that in mind, instead, like the Fed, the Bank of England may choose to spell out its intentions to keep interest rates low for a prolonged period of time, while reiterating that the threshold is not a trigger for a rate hike. So such clarification from the Bank of England over its forward guidance would be very much welcomed by the IMF, as it did call for further clarity on forward guidance, not just in the UK but globally. So we certainly see no rate hikes until the end of 2015, given that the glass is still very much still half full, with the UK economy still facing a lot of considerable tailwinds.
It was interesting to see earnings are on the rise. Do you think rather than plainly targeting unemployment, it will be quality as opposed to quantity regarding the labour market, which will become the focal point moving forward?
Yes, I agree that quality indeed is much more important than quantity, although those two need to go hand in hand. But just to point firstly on the earnings growth, now earnings growth is still incredibly subdued. It's still 0.9% and well below inflation. So negative real wages will continue to cap on the household spending going forward. And this is a concern, especially given the recovery so far has been very much driven by consumption. So indeed, productivity gains remains a very key concern for the Bank of England. It highlighted that productivity per hour continued to fall in Q3 by 0.2%, and furthermore, increased transition from part-time workers to full-time workers does mean that we'll get less additional hiring, so slower decline in unemployment rate going forward.
Sterling soared off the back of the report, suggesting that the market is taking a notion the Bank of England will be pressurised into raising rates earlier. But also falling is the inflation rate. If that were to fall below the 2% target, could this mark a game changer for the Bank of England?
Well, the risk of global disinflation is certainly growing, as the IMF also recently highlighted, due to the flatlining really of commodity prices, not a fall of prices, but flatlining of prices. This is a global issue, as I said, but for the Bank of England, as it acknowledged in its minutes, this does mean reduced likelihood of breaching the 18 to 24-month and also the medium-term inflation knockouts. But if inflation does continue to fall below 2%, there's even less reason to raise interest rates. And as I highlighted, we don't see a rate hike until the end of 2015, so some while yet. One area, of course, of concern for the Bank of England remains house price inflation, and it's driven still by investor-fueled prices in London and the South East. So overall prices, though, remain 8% below 2007 peaks. So although it is one area of concern, it's probably not going to pose too much risk for the rest of the economy. Another area of concern that the Bank of England highlighted was sterling strength. So the effective sterling exchange rate has now risen 9% since March of 2013. So this could add to disinflationary pressures depending on pass-through rates, domestic prices. So as I mentioned, but the central bank is worried about further appreciation also, as this could pose some risks to financial stability.
So following on from that point on sterling, the pound was the best performing major currency in the world of 2013. Data yesterday showed the worst of Europe's debt crisis is over in the eyes of most international investors. This could be given impetus tomorrow as we have the Eurozone PMIs. So as authorities try to negotiate a sustainable rebound, how do you see the pound performing against as the single currency over the coming months?
Well, sitting here in London, also as a European economist, I certainly hope, obviously, that the sterling does continue to strengthen. However, looking at it in realistic terms, both the pound and also the euro are still overvalued against the dollar on the OECD's purchasing power parity measure. So with Fed tapering expectations supporting the dollar going forward, the UK also, with the UK interest rates likely to stay low for a prolonged period of time, it is likely that sterling is going to take a downward trend from now on for the rest of 2014, in our view.
Jinny, it's been a pleasure chatting to you today. Thank you so much. Well, viewers, for more FX forecasts, click back to the website for our Euro-themed Targets in Focus with Ben Jones. Goodbye for now.